Hi everyone, and welcome again to Nettle, the go-to place to learn about finance, econometrics, data analytics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. My name is Sava, and today we are yet again revisiting the KMV model, which is a very famous and popular structural credit risk model that allows to predict corporate defaults using market data and fundamental data from publicly listed corporations. And it's very flexible in that it allows to predict defaults over various time horizons and quite simple yet very insightful in the sense that it uses quite few key inputs, but integrates a lot of important concepts from finance and economics into its build-up. And that's probably is the idea, the reason why KMV remains one of the go-to models in corporate credit risk. Today we're going to discuss how to implement KMV in Excel from scratch, as well as some data sources that you can use to estimate KMV for a company of your choice with publicly available data alone. And the initial example that we're going to use is Greggs, a very famous, iconic, even UK company. And I'll be using investing.com for fundamental data and the Excel stock history function for stock prices. So here we've got the company name and its stock history ticker. Again, we have got XLON as the exchange code and GRG as the company code. And the first thing that we need to specify for the KMV model is the time horizon, that is over which time period in the future, or which forward-looking period are we modeling the probability of default. And the most common is obviously 1 year, and we'll vary it and see how probability of defaults evolves across time. So you can build a default risk curve, essentially the term curve for default risk. And we'll start with 1 year ahead. So for fundamental disclosure, we require 2 years of information. We need both the most recent year, and for Greggs it's year-end 2024, as well as the second most recent, so the year before, 2023. And in terms of the fundamental data, we only need 5 data points. We need current and non-current liabilities. So from investing.com, we can retrieve current liabilities and total liabilities, and then figure out non-current liabilities by just subtracting the current from the total. So current liabilities for 2023 is 272.5 million pounds, and for 2024 it's 310.2 million pounds. For total liability, it's 598.8 million pounds in 2023 and 749.2 million pounds for 2024. So for non-current, we simply subtract current from the total and drag it across. That allows us to calculate the default point, or DPT, for the KMV model, which is, according to the convention, current liabilities plus non-current liabilities divided by 2. So short-term plus long-term divided by 2. That is simply because non-current liabilities, long-term debt, is less pressing. It's less urgent to pay it out because it's long-term, and therefore it, as a rule of thumb, goes into the default point calculation as divided by 2. Again, it's arguably quite simplistic, but it is a good assumption to make, treating current liabilities as more severe, as more urgent, and more impactful in terms of probability of default. That allows us to calculate default point for 2023 and 2024, and we can calculate the growth rate by just dividing the 2024 value by the 2023 value and subtracting 1. So we can see that DPT has grown by roughly 21% over the year. In terms of the risk-free rate, This is an input that essentially models the growth of assets. It's very common to use the risk-free rate, which is 4.57%. That's the yield of a 10-year UK government bond. As of the year-end 2024, that's when we do the modeling based on the data availability. But here you can make a lot of plausible assumptions in terms of what this rate is. You could use the required rate of return from CAPM for this particular stock. You could use empirical asset growth rates over long time periods. Essentially, a lot of inputs can go in here, but the risk-free rate is a good conservative choice, just so that you don't assume assets will grow indefinitely at a very high rate. Asset growth volatility, or sigma, is something that's determined structurally within the model itself, so we'll fill it in a little bit later. And the final fundamental data point that we need to input is the number of shares outstanding, which we can retrieve from the income statement. So essentially, it's 101.78 million shares. This can be retrieved from the section of the income statement that calculates earnings per share. In terms of monthly share prices, we can use the stock history function. We input the ticker, and here we'll need prices from December 2023 to December 2024 inclusive. So we'll start from the start of December 2023, and at the end of December 2024, we'll need monthly data, so 2 as an interval. We don't need the header, we need the date, and we need the close. That allows us to retrieve monthly prices of the Greg stock in pence. Again, for all UK stocks, the price is quoted in pence. That's key for comparability, because the fundamental data is reported in £1 million or million shares, and this is in pence, so we'll need to perform necessary adjustments here. We can see that we've got 13 prices. That's correct, because we've got December 2023 and 12 months of 2024 here. In terms of market value of equity, that's where this adjustment needs to be performed, because the price is in pence. We divide it by 100, that's the price in pounds, and times millions of shares that will lock. That allows us to estimate market value of equity in million pounds to make it comparable with our default point. And now for default point month on month, we make a reasonable and simple enough assumption that it grows uniformly across the year. So we start with the 2023 figure, and then we grow it by the annual growth rate. But obviously, because it's month by month, we raise it to the power of 1 over 12. So it's a monthly equivalent rate. And checking that we've got it correct, the DPT for the end of our sample is exactly the same as the one for the year in 2024. We see that we have essentially evenly scaled our default point, our DPT, across the year, so that we get the same growth rate as here. The market value of assets is something that the model is guessing, because the market value of assets is unobservable. The company has a lot of assets on its books. Some of them are recorded at market values or revalued periodically, but most of them are recorded at book values. And well, we cannot just use the total assets figures from the balance sheet here. This is where the KMV model is ingenious. It essentially says, well, the market value of assets is unobservable, but I'll try to guess what it is and input it to calculate probabilities of default. But we need some starting point so that the model can converge to those true guessed values. And here the idea is very simple. As we know, the accounting identity that assets is liabilities plus equity, we can use that to have a starting point for our model, saying that the market value of assets equals market value of equity plus the default point. And that allows us to have an initial starting point for our calculations, because that allows us to calculate asset returns for every single month, market value of assets this month over the previous month minus 1. And that, using market values of equity and book values of debt, essentially extrapolates what the change of market value of assets is across our sample months, which is the key input for the calculation of sigma, or asset growth volatility. Here we need everything annualized, so we use sample standard deviation of those asset returns, and we multiply it by the square root of 12. As there are 12 months in a year, our initial asset returns are monthly, and volatility scales as a square root. So our initial guess at what the asset growth volatility is 20%, which is quite realistic. Now we use the market value of assets, the risk-free rate, and the volatility to input those into the Merton valuation model. The Merton valuation model is a framework that allows to use the Black-Scholes logic of option valuation to value stocks. The insight of the Merton model is that a stock is essentially a claim on asset value which is above the value of debt. Because, well, if the company goes bust, so the value of its assets is below the value of debt, then due to limited liability, the stock investors do not get anything, but they do not lose anything in excess of their investment amount. But everything in terms of asset value that exceeds the default point or the value of debt is something that shareholders can claim for themselves, which makes the payoff structure of a stock investment in this particular framework very similar to what a call option would provide to a call option holder. Simply because a call option requires some initial investment, the premium, and it pays the investor everything in excess of the strike price as its net payoff. And here we can conceptualize the stock as essentially a call option on market value of assets with a strike price that's equal to the default point or the value of debt. This is the ingenuity of the KMV model that allows you to wrap everything together. So just as in Black-Scholes model, we need to calculate D1 and D2, which essentially are the representations of likely paths of market value of assets as it evolves through time. So for D1, we need to calculate a ratio between, in the numerator, the natural logarithm of market value of assets over the default point. In Black-Scholes, that's current spot price of the strike. For us, the current spot price is the current market value of assets, and the strike price is, an equivalent of it is the default point. And then we add the risk-free rate, locked, plus sigma locked squared divided by 2 times the time horizon. Again, because the risk-free rate, sigma, and the time horizon are the same across our months, all of those are locked. Market value of assets and the default point vary across times as they are not locked. That's our numerator done, and we can do the denominator, which is sigma locked times the square root of the time horizon locked. D2 is essentially D1 minus volatility locked times the square root of time horizon locked. And we can enforce those across the board. And now we use D1 and D2 to calculate what is the implied fair value of equity based on the Merton model. And that is essentially a Black-Scholes call valuation. Market value of assets times the standard normal distribution of D1 cumulative minus the default point appropriately discounted, so times the exponent of minus risk-free rate times time horizon, both locked, times the standard normal distribution of D2 cumulative. That produces a Merton model estimate of what the market value of equity should be. But we have got the actual values for the market value of equity that we calculated to start with. And we can see that there is a slight deviation. We can calculate it explicitly by subtracting one from the other. And this is the mispricing that occurs because, remember, we simply guessed what the market value of assets is. If we allow the market value of assets to vary, we can minimize those mispricings and, in the best case scenario, set them all to 0, so that the model precisely evaluates what the market value of assets is at every single point. That's exactly what we're going to do. We're going to specify our loss function, our sum squared of mispricing. Sum squared is there, first of all, because we are concerned with mispricing in any direction. We don't want the Merton framework to over or undervalue our market value of equity, and also to enable smoothness, because as a square, this would allow the algorithm to converge faster and avoid it falling into any non-smooth pitfalls. So we see that we've got our loss function that we can minimize by varying the market values of assets that we, again, I remind you, initially guessed. We can go to Data Solver and specify our task. Our objective is to minimize our loss function, so cell B31 here, by changing all of our market values of assets in this column. We can leave the box ticked here. Again, market values of assets should not be negative, and we press solve. And our solver has converged to market values of assets that minimized our mispricings. Again, just as I alluded, those mispricings are now set to 0. We can see that those values now match. And this has calculated the market values of assets that are consistent with the market pricing of equity, essentially. And now we can retrieve the value of D2, which we observe at the very end of our observation, so end of December 2024. And that is the value that we use to calculate our probability of default, or in the KMV framework, EDF, expected default frequency. This is a standard normal distribution of minus distance to default cumulative. We see that it is very low. It's almost exactly 0. What does it mean? Well, for many companies, especially well-established companies and companies that are not too aggressive with their debt, that are not very highly levered, as Greg's is, yeah, we can see that its debt to equity ratio, if we use market value, is very small. It's less than 20%. We do observe very low probabilities of default, especially over short time horizons. But the beauty of the KMV framework is that we can extrapolate that to any time horizon we like. For instance, we can just copy the sheet and change it to, say, 5 years. The only thing we need to do is input 5 here instead of 1 and run solver again. Here we see that now the market values of assets are different, the volatility of assets is slightly different, and now the distance to default is 4.17, unlike here it was 9.19, yeah, so distance to default is smaller, but it does not contribute meaningfully to the probability of default, really. So even over 5 years, Greg's is very solid. Greg's is very unlikely to default. But let's say we increase the period, the time horizon, further to 20 years. In this case, if we click Solver, once again, we see that now the market values are again different, but the loss function has again converged to zero in terms of the mispricing. We see some small mispricings year on year. These, if those bother you, can be fixed by running solver again due to imperfect convergence that sometimes happens. But we see that the distance to default is now 2.21, and over 20 years, the probability of default for Greg's is now 1.36%. So over 20 years, the probability becomes non-negligible. But still we see that it reflects the high level of resilience of this particular company. So even over the 20-year horizon, our favorite sausage rolls are not going anywhere, so we can rest easy. But if we look at other companies, we might see other results, especially over the long term. So here I've got the same input for Dr. Martens. So we see that we've got a different ticker input for the stock history function and the relevant inputs in terms of its fundamentals, also retrieved from invested.com. Again, I omit this for brevity. And here we have got the same starting configuration with market value of assets being guessed as the sum of market value of equity and default point. When you proceed from company to company, you can obviously just copy the sheet around and change the values, but most of the time you do need to change this initial guess so the algorithm can converge properly. So let's see what is a 1 year probability of default for Dr. Martens. When we click solve, we achieve again a very low but a non-zero probability of default of 0.02% with a much lower distance to default. And now, as we move to 5 years, for instance, change this time horizon and run in solver, we see that here mispricings don't go to zero exactly. The loss function is quite close to zero, but again, if that bothers you, you could run solver again, and that provides again exact or almost exact convergence, and the 5 year probability to default of 9%, so that's non-negligible. That can be alarming for some debt holders of Dr. Martens, arguably. And if we further increase the time horizon to 20 years, just as we did with Greg's, and again to remedy those small remaining errors, we can solve again and get a 20-year probability of default that's almost 50%. So over a 20-year time horizon, Dr. Martens is as likely to default as it's likely to survive. So that can be alarming for investors in their debt and their equity if we are thinking about this long time horizon in particular. So that is the properties of KMV. Again, it does provide quite conservative estimates of long-run default probabilities. Again, they're very, very large, as there is a lot of uncertainty associated with longer time horizons. But for shorter-term estimations for resilient companies in particular, the estimates are typically quite small. So that shouldn't alarm you when performing KMV estimations for companies of your choice. These probabilities can then be plugged into any analytical tool you are using for your credit risk evaluation. So you can build a curve of probability of default, for instance, by estimating it, say, 10 times for 1, 2 years and further on. You could even input fractional time horizons here that would work as well. And these can be used to, say, build a credit risk value at risk, for instance, if you wish to do so. And this is why the KMV model is so powerful and so popular. It does build quite robustly on many venues of finance theory, in particular the option valuation framework, the Merton model, and the logic of the accounting identity with assets equals liabilities plus equity, and it allows to very flexibly estimate probability of default from very basic fundamentals and stock market data alone. Where it does have some limitations, though, is it's not applicable to private companies because they don't have share prices at good enough frequency, and it is good to the extent that you've got relevant disclosure up to date. So, for instance, here for Greg's, we can only estimate it as of year-end 2024, as that's where we have the relevant liabilities data, yeah, and we are in December 2025 now, so as the data on liabilities is unavailable, we cannot precisely estimate what's going on here. And also you could say that some simplified assumptions that it makes can be not reasonable. For instance, simply using short-term plus long-term divided by 2 is maybe an oversimplification, or simplifying the growth rate of assets to the risk-free rate or any other single figure that then extrapolated could be problematic, viewed as problematic as well. But nevertheless, KMV remains very, very much a standard structural credit risk model. And that's all there is for KMV and its application in Excel. Please leave a like on this video if you found it helpful. In the comments below, make sure to see any further suggestions for videos you would like me to record. And please don't forget to subscribe to our channel. Thank you very much and stay tuned.